Hello, welcome back to the Money Corner. And if you're watching now, it's just about New Year's Eve. It's December 31st. You'll soon be concentrating on celebrating and welcoming in the new year, welcoming in 1986, rather than thinking too much about money. But for a little while, stay with us and talk about money, talk about your future, talk about retirement, and talk about pension planning. Because I've got two authors with me tonight, people who are authorities in the area of pension planning. Both gentlemen, Stephen Krass of Manhattan and Richard Keschner of Rockland County, are authors of a book called The Pension Answer Book. And fellas, I must tell you, I was fascinated by the format of the book, the way you laid this out. Both of you have been involved in the field of legislation affecting pensions for many, many years, I assume.
Well, my background was to spend 10 years with the IRS, both in the audit division and as a pension supervisor, and I've used that experience while practicing as a pension attorney for the last 9 years in representing clients.
And both of you are senior partners in a law firm in Manhattan, where a good deal of the work of the law firm is in pension planning, mainly for medium-sized and larger corporations?
Not quite. A good percentage of our business, in fact, is related to the small, closely held business, whether incorporated or not. And I would say I spend about 98% of my time in the pension area.
Fellas, if we go back and you think back of some of the major cases in the United States that brought about, we're in an era of great legal reformation in terms of pensions now. We get TEFRA and ERISA, the jargon coming out of Washington. But for the past 8 to 10 years, Congress has really been concerned about the way pensions are administered in the United States.
Well, you really had it start with ERISA in 1974.
Why? What brought ERISA about?
Well, there were shows on television such as Broken Promise. People who had been union members for years and years but never received any benefits because they would have a break in service and wouldn't have 25 consecutive years. It was primarily the motivation for Congress and to involve both the Department of Labor and the Department of Treasury in reviewing the whole pension structure, such as funding of benefits, to make sure that there would be money there when people retired, to make sure that there was accelerated vesting so that you didn't have to be there for the rest of your life in order to finally receive benefits.
All right, fellas, I want people to learn tonight. Accelerated vesting. Vesting, what do we mean? What are we talking about?
Vesting represents the percentage of one's right to one's pension at any given point in time. It would not have been uncommon in the days before ERISA for someone to literally have to work till retirement age, which was normally 65 and probably still is normally 65, before one would have a completely vested right to that pension, and in many cases would have no vested right at all, so that someone could work, as Steve said, literally for 25 years, even without a break in service, and potentially get nothing if he quit a year before his retirement age.
So vesting really means ownership. The word vesting means ownership.
Ownership, but without necessarily one having the automatic right to immediately get that benefit when one leaves the company.
But it does mean ownership at some point in time.
Yes, I would go along with that, yes.
Okay, ERISA, the word ERISA.
Well, when I was with the IRS, the Assistant Commissioner for Employee Plans used to refer to it as every rotten idea since Adam. But what it means, the acronym means, is Employee Retirement Income Security Act. And as Steve said, I would summarize the three highlights as being the vesting, the funding of the plan, which led to the creation of a separate government agency, the Pension Benefit Guarantee Corporation, to assure that these benefits would be there when eligible participants were ready to retire. And it also shortened the period of time that an employer could require an employee to have to work before one could be eligible to join a plan.
In effect, much of the manipulative behavior, or many of the manipulative practices that some people imposed on labor were eliminated or were policed by ERISA. Is that a fair description?
Yeah, I'd say very much so, with the advent of the Department of Labor and their involvement now in pension plans. To cure some of the abuses and the investments, there is a whole new area that came in with ERISA called prohibited transactions, that there are certain transactions that cannot be entered into between a plan and a party in interest, such as the company that sponsors the plan or the union itself. And this whole new area opens up the ability for the Department of Labor to really police what goes on in plans and to make sure that the funds are there to provide the benefits for the participants when they get to retirement age.
You know, let me comment on the word manipulate, because that has a negative connotation. But one of the things that we can do, and have successfully done over the course of the last number of years, is to structure a plan, to change the word manipulate to structure, so that it basically benefits the principal or the key people of that firm, which is basically why we get engaged as attorneys with regard to specific clients. So there's a positive side to that manipulation.
Well, I can understand why a businessman who owns the business wants to make sure that he gets a fair share of the retirement benefits, but I also think in terms of morality and conscience that every employee who has worked faithfully is entitled to some type of reward for service.
Sorry, Phil. That's pretty much what happens when you sit down. The clients run the spectrum of those that want to avail themselves of the law to its nth degree so as to preserve the maximum benefit for themselves, to those that say, I want to reward my employees who stay with me, they deserve it. And so that's something you can ascertain from an initial meeting with a client, but I would say that it runs the entire spectrum.
Well, really the restructuring of the pension law over the last 10 to 12 years has been geared to making certain that you have to give benefits to the rank and file employees and not to be able to exclude them wholesale from a plan and just leave benefits for key employees. The client looks at it in a way of, is this an idea which I promote to my employees to stay with me? The typical plan, a profit-sharing plan that an employee should share in profits, is that the employee will stay with the company. Turnover is not a good idea for business. To constantly break in new employees and to train them is not cost-effective. And the plan can be used as a hook to keep the employee with the company. And many companies look at it that way. Other companies or employers will say, well, I will only put in a plan if I can benefit substantially from it. Otherwise, I'll look for other ways of getting money out of my business through salary, through bonus, and not necessarily benefit the employees.
Well, what Steve is saying is a natural lead-in to what happened in 1982, and as a follow-up what you were saying about why ERISA came along. Notwithstanding that what was being done with regard to many plans for smaller businesses was perfectly within the realm of the statutes that existed at that time. In the spring of 1982, there was a sudden development of substantial changes in the wind in the pension laws again, which resulted in TEFRA, the Tax Equity and Fiscal Responsibility Act of 1982, in which one of the major changes was this shrinking again of the period of time that an employer in a plan where 60% or more of the benefits were for key people, the vesting period now shrunk to a maximum of 6 years from what was typically, prior to TEFRA, an 11-year maximum before an employee would be fully vested.
Is that where the vesting period is now, 6 years, or is it shrunk even more than
well,
that right now?
There's a whole new area now called top-heavy plans. And a plan is top-heavy if the basic, what's known as key employees, have more than 60% of the benefits. And if a plan is top-heavy, then you have a choice of two alternative forms of vesting. One known as graded 6, which is 20% after 2 years of service, and graduates 20% thereafter. So at the end of 6 years, the employee participant's 100% vested. The other alternative is what we call Cliff 3. No vesting until the end of the 3rd year, and then you become automatically 100% vested from that point on.
You're talking about everybody in the firm?
Everyone in the plan.
Everybody in the plan. I meant that, everybody in the plan.
The difficulty that there is that when Congress enacts these laws, they seem to think everything is in black and white, that a plan is top-heavy, a plan is not top-heavy, and doesn't realize that plans can fluctuate between being top-heavy and non-top-heavy from year to year, depending on what kind of contributions or benefits are accrued during that year. So in 1 year, you could have an old-style vesting on the so-called 440 that Richard alluded to, where full vesting after 11 years graduated from 4 on, and the next year be then in a top-heavy year and be involved with a graded 6.
No, but that brings about the need for a mid-course correction. You have to adjust your funding.
Not really, because we don't do administration, but could you imagine the difficulties of administering a plan where one year it's not top-heavy, the next year it is, and the third year it's not top-heavy again, and the employer can then run 3 different vesting schedules potentially for a particular participant. It's very confusing. Could be very confusing.
Congress seems to be in between. And the question is, are they looking at the private pension system to support Social Security? And
Aren't they?
well, the question is, as they keep making these changes, once ERISA came in, pensions became very visible. For years and years prior to ERISA, you had no major changes in the law. With the advent or enactment of ERISA, you've had a whole series of laws, and particularly in the last 3 years. And you have proposals today coming out of the House Ways and Means Committee, coming out of Treasury. And what happens to the smaller corporation, the mid-sized corporation, it starts to become too costly to administer a plan and to constantly make changes from year to year. And it gets into a situation where the client will say, well, maybe I shouldn't have this anymore. Why should I do it? Now, who's going to suffer? It's the rank and file employee who's going to suffer, because he or she is no longer going to have benefits provided by the corporation. The owners of the corporation will find other ways to make their own retirement and to build up their funds. So it works at cross purposes.
I've mentioned the 82 Act, and then there were 2 more that came along in 1984, and it's unfortunate, and not having spent a great deal of time in the Army, but having been in there long enough to know about acronyms, we tend to talk in terms of acronyms, which you mentioned before as well. So we have TEFRA, which is 82, we have DEFRA, which is 84, and we have RIA, which is August 84. And we have just finished a cycle of amending the overwhelming majority of our clients' plans, when lo and behold, it looks like in 1986, on the horizon is still potentially more changes.
Okay, let's summarize now and help me understand, help the audience understand the sum and substance of all those changes in the law. First, vesting has significantly shrunk, so people in the great majority of plans have a degree of ownership within between 3 and 6 years.
Correct.
Whereas in past years they might have had to work for 11 years, they could be dismissed or lose the job and lose all those benefits.
Well, generally, they would be graduated vesting from the 4th through the 11th year, but you had to be there for 11 years in order to be 100% vested in your benefit.
And now you can get that probably within 3 to 6 years.
Correct.
Right.
We now have a concept in pension work in the United States of portal to portal. We can take the accrued benefit or the built-up benefit to another place of employment.
Well, you don't have, technically, you don't have portability in the corporate pension system. You may have a vested benefit which you could receive when you terminate employment, and then take that and roll it into an individual retirement account, or roll it into a qualified plan of your new employer. But that's not technically portability, because when you start with that new employer, you're starting them from day one in their plan with their benefits and starting to build vesting from that point on,
Well,
not receiving credit for the time before.
And furthermore, there's no guarantee that that new employer will either have a plan or have its plan permit a transfer from any other plan.
No, but that's a part of the search process, that a man can choose a company without a plan, or he can choose a company, he or she, a person, man or woman, can choose a company
Okay,
with...
then it's important to understand that if that particular person is fortunate enough to have received a distribution from the former employer's plan, even if the search is unsuccessful immediately, to find a new employer which has a plan that will permit this transfer, you are allowed to establish a rollover IRA account, which you are allowed to use as long as you wish, and in the eventuality that you do find this successor plan, roll it right back out again. So it need not be immediate. It's not a 60-day requirement that you must do this from the time you leave one employer and get your distribution.
Yeah, I would like both you fellows to do more of this, because you're really invited here as counselors and teachers, and I think too few people understand the point you just made, Richard, about that rollover into the IRA and why one keeps it segregated to eventually roll it to a new employer.
Well, I'll tell you, Phil, it's really the kind of law that you must keep up with on a daily basis. I remember we subscribe to about a half a dozen different weekly pension and tax services, among other services in the office. And I remember Steve had passed on one of these tax services to me, and I was reading through one of the private letter rulings, which are rulings issued by the National Office of IRS to a particular taxpayer.
Richard, hold it right there. We're going to have to pause for a public service announcement. We'll come back when we talk about the IRS and the private letter ruling. Stay with us, please. We'll be back in just a few seconds. Thank you for being with us, and thank you for staying with us. We're talking about pensions tonight, first night of New Year's Eve, and I have two guests who are attorneys practicing in New York. Steve Krass is an attorney who lives in Manhattan, was good enough to come out here to Bergen County tonight, and Richard Keschner came by. He's on his way home. He lives in Rockland County. Both men are, Richard is formerly with the IRS, and Steve, both of them have co-authored a book, the Pension Answer Book. Fellas, I want to get into the book. I'm very impressed with the format of the book, and you've done it in an interesting way. You've taken major topics and then indexed the major topics and created questions around each of the major topics. Would you tell us a little about this format and how a businessman would use it?
Well, what we've tried to do is to break it down into particular areas, that if you have a specific question, then hopefully you can find that question and that answer right there, and try to answer the questions in 1, 2, 3 short paragraphs so that you do not have to read through an entire chapter in order to find your subject. There's a table of contents, there's an index in the back also, so that you're able to focus in on your question, and we try to give you a short answer with some citations. So it could be used by other attorneys, by accountants, by pension administrators if they have to go further and deeper into the particular subject. Such as IRS regulations, rulings, Internal Revenue Code sections. We do cite those with the answers.
Well, excuse me, but it's also addressed to the owner of a business who may want to get some quick answers to questions that are most commonly asked in this area.
I really think there's a need, maybe you two will do it, prolific authors that you are, there's a need for this type of book for the recipient of the pension, for the average person who someday will qualify for a pension. Perhaps not in that kind of detail, but one of the things that has become evident to me is the tremendous ignorance on the part of most people about what their pension rights are, how to plan in terms of their financial future. Of course, the whole area of pension is fraught either with anxiety or a lack of knowledge.
Well, there are chapters that would deal with that. There is a chapter on retirement benefits and taxation. There is a chapter dealing with rollovers. So that would deal for the participant or recipient who's going to receive benefits on what options they have and what the tax ramifications of that. There is another chapter on reporting to government agencies and summary plan descriptions, which is a document that must be given to each of the participants and their beneficiaries in a plan, outlining what their rights are, what the benefits are, and basically a summary of what the plan is, but in simple language that they can understand. Under one of the changes brought about by the '84 Acts, when a person is to receive benefits under a plan, the plan administrator is to give them a statement outlining what the different options are, such as rollovers, whether it qualifies as a lump sum distribution for tax purposes. So this is something new that started in 1984, and basically effective for calendar year 1985.
But there's another facet of that that's quite important to understand, which is creating a bit of another administrative burden, is that if any participant is married at the time of a potential distribution, the participant is required to get the distribution in the form of an annuity unless that participant has the spouse agree to some form of distribution, such as a lump sum distribution, other than an annuity. And that particular signature must be notarized so that the administrator, the employer, the sponsor of the plan, must protect himself or itself before making any distribution other than a joint survivor annuity without having this on file.
What you have sort of is a federally mandated community property in states which are not community property states. what the government has done, or Congress has done, is to take primarily pension plans. There is some exception for profit-sharing plans, and saying that you cannot make a distribution without the spouse's consent. That if a husband were a participant and wanted to designate his children as beneficiaries, could not do that without the wife's consent, and vice versa if the wife is the participant. You have, I think, some significant constitutional issues that have been raised by this law, which is the Retirement Equity Act of 1984.
It sounds very much like this is the legislation influenced by the feminists.
Well, that's what the Pension Equity Act, I'm sorry, the Retirement Equity Act has some other less well-known names which escape me right now, but it has definitely to do with fairness towards women.
I remember
pension law.
Geraldine Ferraro made a big case out of her impact in this area. This was one of her missions in Congress when she was in the House.
Without reading too much into it, the law was enacted August 23rd, 1984, in the midst of an election campaign. So one might surmise that there was something political.
Well, I'm not
involved.
concerned about the political part of it. I think it's interesting in terms of how...
She was prominent in the legislation. As I said before, it has created some constitutional issues. You have, in many situations in second marriages, prenuptial or anti-nuptial agreements where the spouses give up rights in each other's estates based on regulations or temporary regulations which have been issued by IRS in this area. The anti-nuptial agreement would be invalid with respect to benefits under a pension plan if that waiver was executed prior to August 23, 1984.
Have we seen test cases come down yet? Are they starting to work through the courts?
It's too early, but it's going to happen. And I think you're going to have provisions. ERISA was the first one. ERISA basically said this is a federal law and it preempts state law. But then a lot of carve-outs were made from that. And one of the carve-outs was in domestic relations, in the event of divorce or separation. And the states pretty much said that ERISA did not preempt that area because the marital rights of a husband and wife were to be governed by state law, not federal law. So you're going to have a situation here where the question will arise, and I have a feeling that the state courts will take over in that area and say that this is a federal law and this cannot overrule the state's power to govern the matrimonial situations of their citizens.
I'm trying to understand that law. If there's no consent from a wife, the distribution that a person earns, well, in this case it would be a man, the man earns while an active employee, those vested rights when he's ready to be paid, would come to the couple in the form of an annuity, an insurance policy.
Well, it's effectively what's known as a joint and survivor annuity. So that while the husband is alive after retirement, he does receive benefits on a monthly basis. But in the event of his death, then those benefits are continued at some level, generally 50% or more to the spouse.
If a man is about to retire and he wants cash, he better get that letter of consent from his wife.
Yes, he must have it. And that consent she must acknowledge that she understands.
Now go figure this one out, Phil. In the same regulations, the IRS has taken the position that even if you have an unmarried participant, that participant is has to get an annuity unless he or she affirmatively states to the administrator, I don't want it. I want a lump sum
alimony?
distribution.
Is that what you're referring to?
No, this is an
This is just totally unmarried participant.
Single participant, never been married, no palimony involved. Must get an annuity unless he says or she says, I don't want it. I want a lump sum distribution.
Strange.
Yeah.
Yeah, I don't think interesting is the word we use.
Strange.
The world of the bureaucrat.
That's right.
And even in the same aspects with this Retirement Equity Act, that if a participant dies while a participant, the death benefits under the plan must be payable in the form of a qualified pre-retirement survivor annuity to the spouse. And if that participant wanted to designate his or her children as beneficiary of the death benefits, must get the spouse's consent.
Now, I started to say before something that is in line with what you pointed out about individual planning. When Steve passed one of these weekly tax services to me, and I was reading some of the head notes, we call them, the summaries of what was in there, I saw something that looked like a change of position by the IRS, and then I requested from the particular service the complete transcript of what this was. And sure enough, the IRS had reversed a position that it had taken at least twice before that we were aware of with regard to other taxpayers, where they said you could no longer, right on the theme we were talking about before, get this distribution from a qualified plan roll it over to an IRA, and then decide before you file your tax return, hey, I don't want an IRA, I really want this 10-year averaging, which is a way of lowering your tax. Get the money back out of the IRA and pay at the lower tax rate. And they had approved this at least twice before. They did a complete reversal. Now, this has been picked up subsequently by all the other tax services as a change of position. Yet, and you might think, well, how could IRS do this? But the IRS, ever since they instituted this private letter ruling program, which I think is at least 8 to 10 years old, has stated in every single ruling that this can only be relied upon by the taxpayer who receives it and by no one else. And now they've definitely taken that position further.
So, Steve, we have about 3 minutes left, and I want to get one other topic while you're here. I understand that in the firm, in addition to doing work on pensions, you also work on financial planning and estate planning. Could you outline very briefly some of the mandatory things that the average viewer should be doing, even of modest income, modest wealth, that's important in terms of protecting one's assets or maximizing the assets, little rules of thumb?
With the changes in the estate tax laws over the years and going back to our acronyms, ERTA, the Economic Recovery Tax Act of 1981, basically permits a free transfer of assets between a husband and a wife. So you have no estate tax or gift tax consequences.
Are you saying in year 1 the husband can give the wife $30,000 and in year 3 she can give it right back? You can just flow it back and forth between
You could
the two
even raise
people?
that to $30 billion, and you would not have any federal estate or gift tax consequences. But in addition to that, many, many years ago, you were permitted to pass through your will in an estate tax situation $60,000 tax-free. Well, right now that's $400,000. In a few hours from now, when we get to January 1st, that will be $500,000, and in 1987, when it's fully phased in, it will be at $600,000. So that people, through their will, are able to leave $600,000 to someone other than a spouse on a totally federal estate tax-free basis.
In effect, then, if you have 3 children and you've got $600,000, you can give each of them $200,000 totally tax-free.
Correct. Correct. And depending on the size
And they
of the
pay no
estate-
tax on that gift, and you pay no tax on that gift. Is that correct?
Correct. Correct.
The income thereafter becomes taxable to the child who receives
If you're
the
looking at it from an estate planning...
So that's one way of getting the money out of your estate and minimizing the federal tax.
You can still do it through your will. You can still do it in the same way. That
still
if you
avoid
left
the-
property to your children, or you left it to a trust for the benefit of your wife, and many will choose to do it for the benefit of the spouse, to give the surviving spouse the income from the property.
So the assets of many of us will not be taxed away by the federal government as they were in the past.
Correct.
It's very good.
And with a husband and wife, you will be up to $1.2 million
Yeah.
of estate tax-free dollars.
Yeah.